This video is on Chapter 20, which is on Master Budgets and Planning. This video will review the alternate exercises 3, 8, 9, 14, and 17. We'll look at a production budget, direct materials budgets, direct labor and factory overhead, and a cash budget. First is exercise 20-3, and they want us to prepare a production budget for 3 months, April, May, and June. In this information, it tells us that the budgeted sales are $640 for April, $700 for May, $670 for June, and $740 for July. And it tells us what they want the ending finished goods inventory to equal, 20% of the next month's sales. And our finished goods inventory at the beginning of April is 128 units. So they have to tell us that information. So here we're doing April. So we believe we're going to sell 640 units. Our desired ending inventory is equal to 20% of the next month. So the next month after April is May. So 700 times 20%. We want our ending inventory to be equal to 140. We believe we're going to sell 640, but we want to have some safety stock in case we sell more than 640. Total required units is 640 plus 140, and subtract out our beginning inventory because we already have those units. They need to produce 652 units. For May, the desired ending inventory will be June of 670 times 20%, which is 134, 700 budgeted sales plus 134 is required units of 834, but we already have some beginning inventory of 140, which is our ending inventory from the previous month. So this 140 comes down here. The ending inventory from the previous month is the beginning inventory for the next month. In May, they need to produce 694 units. June, they're starting with 670. They need to compute their desired ending inventory. July times 20%, 670 plus 148. Total required is 818. Subtract out beginning inventory, which is from the previous months. Beginning inventory in June is May's ending inventory. In June, they need to produce 684 units. Now we're looking at exercise 20-8, alternate. Here also we're going to look at a direct materials budget. This says that each finished unit requires 2 pounds of direct materials, and they want to end each month with direct materials equal to 40% of the next month's production needs. The beginning direct materials inventory for April is 400 pounds. So again, this information they have to provide to you. The cost per pound is $6. We will prepare direct materials budgets for April, May, and June. So these are the total units that we want to make, and each unit requires 2 pounds of materials. So now we're going to look at the direct materials budget. First, we transferred down here from the units to produce for each of the months. Each unit requires 2 pounds of material, so we're going to multiply those. Add the desired ending inventory. Their desired ending inventory is equal to 40% of the next month's production needs. So in April, it will be 40% of the next month. The calculation is here, 40% of May. So we're looking at $12.40 of materials needed times 40%, so $4.96. So we'll add that to the 1,000 and subtract out our beginning inventory. They told us it was 400 pounds at the beginning of April. This will tell us how many pounds of material that we need, and we'll multiply that by the cost per pound. So in the month of April, they will spend $6,576 purchasing their direct materials. In May, their ending materials inventory will be equal to 40% of June. So June is 1,300, 40% of that is 520. Add those together, subtract out our beginning, which is from here. So the ending from the previous month becomes the beginning for the next month. Subtract, multiply by $6 to get the total cost. In June, we want 40% of July. July is here, 800 times 2 pounds of direct materials per unit times 40% is 640. Add, subtract the beginning material because we already have it. We don't need to purchase that part. Subtract to get the materials we need to purchase, multiply by the cost per pound. In June, they need to purchase 8,520 pounds of material. Here we're looking at the production budget for Ramos Company. In this example, each unit requires 5 pounds of direct materials, and they want to end each month with direct materials inventory equal to 40% of the next month production needs. And they tell us what the beginning direct materials inventory is. The cost per direct material is $5. So this one is just like the one we just went over. First, list the units for each month, April, May, and June. And then we're going to multiply by each unit requires 5 pounds of material. Multiply those out. Add our desired ending inventory. So they want 40% of the next month. So in April, we want 40% of May. Comes to 1440. Add those together. Subtract out our beginning, which was 1280, they told us, pounds. Multiply by the cost per pound. In April, they need to pay $16,800 for their direct materials. So again, we'll go through these same computations for May and June. In June, we're looking at 40% of July. July is 760 times 5 pounds per unit, so 40% of 3,800 pounds. Now we're looking at a direct labor budget and a factory overhead budget. For direct labor, it says each finished unit requires 0.4 hours of direct labor at $15 per hour. And we also know that their variable overhead is $20 per direct labor hour, and the fixed overhead is $4,000 per month. Start off with the units to produce. Transfer these numbers down here and Each unit requires 0.4 hours. So we'll multiply. And then we will also multiply by $15 per hour. That gives us our total cost of direct labor. So we'll do that for May and June. Factory overhead, it says variable overhead is $20 per direct labor hour. So right here, this row shows us our direct labor hours needed. And those are the numbers that are transferred down here. Multiply by the $20 that they told us. Add the fixed overhead, which is $4,000 per month. Add these together to get the total factory overhead budget. Now we will prepare a cash budget for 3 months. This column lists the cash coming in. This column lists the cash going out. Also, it says they require a minimum cash balance of $50,000. If they don't have $50,000, they have to take a loan out, and if they have a loan, they have to pay 1% per month interest. Any preliminary cash balance over $50,000 would be used to pay back any loans that they have. The company has a cash balance of $50,000 and a loan balance of $100,000 in January. So we're going to prepare cash budgets for January, February, and March. So first we'll list our beginning cash balance. They told us was $50,000. Add cash receipts, which is up here. That gives us total cash available. We have to subtract out the cash payments. We do have interest in January because they have a $100,000 loan balance. So we'll multiply that by 1%, which comes to $1,000. Subtract cash available minus $705 minus $1,000. We have a preliminary balance of $89. So we have to look at this number and determine if it's greater than 50, which it is, and since it is greater than 50, but we need to make sure we have 50,000, the difference between 89 and 50 is how much we can pay back on this loan. We can pay back 39,000 of the loan to leave us 50,000. Now we will compute the ending loan balance. 100,000 minus the 39 that we're going to pay back. Now we have a loan balance of 61,000. We start off February with 50,000. Add the cash receipts. Subtract the cash payments. Interest is computed on 61,000 times 1%. Preliminary balance again is greater than 50, so we can pay back some more of our loan. Can we pay all of it? We need to make sure we have 50,000, so we cannot pay all of it, but we can pay 48,390 of it. So 61,000 minus 48,390. Now we only have a loan balance of 12,610. March starts off with our beginning balance of 50,000 from our previous month's ending balance. Add cash receipts, subtract cash payments, loan interest 12,610 times 1%. Preliminary balance, we've got a minus here. That means we need to borrow some more money because we have to have 50,000 as our ending cash balance. So we have to make a loan of 63,126. We owed already 12,610. So adding the 63,126 to the 12,610 means that now we owe 75,736 in order to maintain our $50,000 loan balance. This concludes the Chapter 20 alternate exercises.